I'm Michael Fox, and this is the Prospector News Podcast. And I am joined by the national investor, Chris Temple, because if there's ever a week we need knowledge and not speculation, it's this one. Welcome, Chris.
Thanks, Mike. And that's very, very true. Two big events this week.
Yeah, there was two very big events, and let's kick it off with the Grand Powwow in Jackson Hole.
Well, every year, as most folks know, of course, the Kansas City Fed hosts their annual end of summer picnic / gab fest / policy floating forum and whatnot. And typically, where it concerns the Fed chairman specifically, this is the time more often than not that the Fed chairman likes to lay down a broad vision of what he sees in the immediate future, what's in his mind, and so forth. And look, and you saw this from me, I speculated that ahead of this meeting that the Fed, some of whose members have publicly started to say that they're concerned that the Fed may go too far with rate hikes and they would like to get the monkey off their back a little bit. I thought we were going to hear more from Powell about how the Fed is doing its job, but that to get sustainably back down to 2% inflation, they need help. They need help from policymakers. They need help from the fiscal authorities not running up deficits as much and that causing interest rates and inflation to rise and all the rest of this stuff. And we heard a little bit of that from Powell this morning, but not near as much. What we got instead, and I frankly am personally, and you know the kind of Fed watcher I am, I'm more surprised than the average potentate I was hearing interviewed on CNBC, although they all unanimously said that this was a bit more hawkish than expected. This was an extremely hawkish statement that came out of Powell this morning, a speech rather, I should say, not really a statement. He's right back to pounding the table. You know, it's a 2% inflation or bust. You know, he said 2% inflation is our target. It's going to remain our target. That's not changing. And he went through a litany of reasons as to why, if you know, you got to place a bet one way or the other, that they are not yet done raising interest rates because things are not going yet according to plan. And so about the only significant difference now, as opposed to last year in Jackson, Wyoming, when his speech really caused a big air pocket drop in the markets, and he used the term pain, that the average American and the American economy was going to have to feel some pain. He didn't use that exact word, but aside from that specific word being absent, he said much the same thing as he did last year. So as a result of that, the stock market, which had been up a lot ahead of his talk, went down a fair bit. You know, you and I are recording this early afternoon on Friday. It's recovered a fair bit since then. Gold dropped, I think, $20+ from its peak to its low, and it's still down as we're talking. And you know, this was anybody who is looking for a signal that you can ratify this year's rally in the stock market, that you can pull the trigger and load up on more gold or any of those kind of things. You didn't get that today. You got quite the opposite.
Yeah, he wasn't very positive, that's for sure. The one thing that I kind of half expected that didn't happen was I thought they might actually pivot from that 2% to a higher number, but that didn't happen. And they pounded that table. It's 2%, 2%. Some of the key phrases, you know, the job market has to have some negativity in it, and as we follow the job numbers, you know, they keep raising the rates and nothing seems to break. So I'm still in the camp that I think they've got another quarter-point hike coming in the next meeting.
Well, in the next meeting or the one following, there's still some debate. Now we're going to get next week, Mike, we're going to get the PCE number for September, which is the inflation measure that, besides the core CPI, that's the one that they follow as much as anything. It's probably ticked back up. But there were, picking up with what you just said, Powell had recently softened some of his hawkish rhetoric, especially when it came to the labor market. I think it was after the last FOMC meeting, he said, well, hey, we never thought this was going to happen, but we've raised interest rates 5% fully now. And yet the unemployment rate is exactly where it was when we started raising interest rates. So none of us would have expected, I'm paraphrasing, of course, none of us would have expected to raise rates 500 and I guess 525 basis points from the bottom and still have the unemployment rate where it is and still have some decent wage growth and the rest. So, hey, that's a nice outcome. But then this morning he went right back to saying that's a bad thing and don't expect it to last. And for as long as it lasts, we're still going to have a bias to tighten, because that's one of two things he said from the start that we're going to have to see in order for them to think that the job is over or nearly so. Number one is some meaningful weakness in the labor market, which you really don't have, but for structural reasons as much as anything. And the other one being below trend economic growth. Well, according to the Fed, trend economic growth measured by GDP is between 1.5% and 2% a year. If it's to be believed, the Atlanta Fed, which was spot on in the recent past, thinks that we could actually get 5% plus GDP growth by their reckoning when the third quarter is over. Nobody at the Fed wants to see that. So both of these things, below trend growth and the softening labor market, they're not going the Fed's way. And he also threw in, which again is a structural thing that the Fed can only control so much. He also threw in real estate. And look, I'm talking to you right now from northern Wisconsin, which is not exactly the poster child for a hot real estate market like where I live in Florida, where there's been relatively little softness in prices. But believe it or not, and I've talked to a couple of my grown children and some other people up here, and I've looked at prices, after an initial decline, and a noticeable one, in what real estate was selling for around here 6 to 12 months ago, as mortgage rates started to go up meaningfully and stuff like that, guess what? Prices are back to where the peak was in a lot of ways. So that's another thing Powell pointed out this morning, is that golly gee, one of the things feeding inflation is housing costs, and they got nothing to show for that now, for the most part. I mean, there are certainly differences in local markets and in types of property, but generally speaking, they haven't gotten any more progress with real estate prices at this point than they have with labor growth or the economy. So, unless China drags us backward real fast, yes, the Fed is going to raise rates more, and probably more than just 25 more basis points.
Yeah, I wouldn't disagree. Like the mortgage rate in the U.S. just hit 7.23 today, if I read the numbers correctly. That's up dramatically over a year ago. But like here on Prince Edward Island, housing prices haven't declined. They're up where they are. The only thing that's changed is it's taking longer to sell that house.
Right.
But as we've gone over, like the higher mortgage rates have a tendency to have a 2 to 3 year lag, because a lot of people, they would have, negotiated their mortgages 2 or 3 years ago before the hikes. Well, the hikes really just started in the last year, but they would have negotiated those rates, and they're good for 5 years. So unless they were on a flex mortgage rate, they're not feeling the pain of those higher interest rates now, but next year, the year after, and the year after that, as the mortgage comes up for renewal, that's when I think you're going to see that real estate margin call happening, where people, are going to actually have to sell their home because they can't afford to keep it at the higher rates.
Well, look, you're absolutely right about that, Mike, and there isn't any question that it's only a matter of when all of these rate hikes to date, and the ones still quite likely to come, are going to do what they're intended to do, maybe to an extreme when all is said and done. And that's one of the reasons why I think that Powell will, even though he didn't really address these things as I thought might have been the case this morning, he will, I promise you, the next time he's in front of Congress shortly for his Humphrey Hawkins testimony, which he gives every 6 months, you may see him stress even more the job policymakers have. And I guess that's the right form to do it anyway, is when he's back in front of the House and the Senate. But there are a lot of things in his way. And again, some of them he alluded to this morning. But you and I talked, I think the last time we did one of these discussions, Mike, about wage growth and about how, you know, and it just came out in the news in the last few days, the UPS employees ratified a massive, I mean, the best that they probably ever had, increase in pay and benefits. And this is one area where Powell is still somewhat in denial. You know, for so long, we remember he told us that inflation overall was transitory. It's going to go away. We don't have to respond to it. This is one-off stuff because of the pandemic and supply chains and blah, 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 blah. And guess what? It wasn't transitory. Well, he's also told us recently that the component of this that deals with rising wages is also an aberration, that it's not anything that's going to last. You know, we don't see, he said, the kind of wage price spiral that we did back in the late 70s and early 80s. Well, I beg to differ, but it's here. It's in the headlines. So that's going to be working against them. Part of the reason, again, another thing that's not directly in the Fed's control is demographics. You've got shrinking labor forces most places in the world, in many key industries in the world. And so guess what? That means when you've got a lack of supply of labor and qualified labor for some industries, you're going to pay up for it. And so that's why this is going to be one of many factors that's going to keep inflation extremely sticky. Not to mention, one of the other subjects we'll talk about is going to be the outcome of the Brics summit, that worldwide you are going to see much higher pricing thresholds for most commodities in the immediate future. So, you know, you got that, you got the shortage of housing. You know, maybe Jerome Powell and his cohorts at the Fed can impact demand for housing by making it too expensive to get a mortgage. But the other part of that is not his job is when policymakers, instead of spending tens and hundreds of billions of dollars to conquer half the world and to fight this proxy war with Ukraine, with Russia over Ukraine, maybe they should look to build affordable housing in the US and make housing affordable for the average American, et cetera. So there's all of these different structural things and political things and the move away from globalization, every single one of which is going to make inflation higher than we've seen in the last 40 years. And so, you know, if you take him this morning at face value, and he's going to keep all of this on his shoulders, and I'm completely wrong about him at some point pivoting and trying to put it on policymakers, then this guy definitely is sooner than later going to pull out one too many sticks from that Jenga game, and he will implode the entire economy. I hope it doesn't get to that point.
Yeah, it's interesting what you're saying about the housing market, because here in Canada, housing is starting to set front and center in our political discussions. Housing costs continue to rise. They're out of control. There's reports now of, immigrants that came here for a better life. They're going, I can't afford to stay there, and are going back, and in some cases back to war-torn Ukraine, and they go, well, war is better than not being able to afford the roof over my head, as an example. But I've got a friend in Vancouver that's got housing insecurity, and she's stuck in an apartment that's substandard and can't get out because she can't afford what the market rates are for a 1-bedroom apartment in Vancouver. And she said, well, you keep saying that the housing's gonna, collapse. And, so that I just have to wait this out. And I'm going, well, no, it's going to collapse, but there's going to be a bunch of people that are going to have to sell their houses. And then they're going to go into the rental market where there's not enough rentals to begin with. So it's going to be, I think, a situation where, yeah, one side of the equation is going to go down, but the other side's going to go up, and it's going to throw things continue at it to throw things continually out of balance.
Well, it will, and again, this is the reason why there needs to be a call, not just for the Fed to clean up the mess that, again, it was the chief cause of, not the only cause of, but the chief cause of, because they're the ones that print the money. All right. What makes it worse are things like this, where you've got supply and demand imbalances, where you've got underdevelopment of resources, where you've got slack labor pools, and all these other things that we're talking about, all of which are going to lead to a much higher threshold of prices going forward. I said over a year ago that sure, we're going to see inflation come down in 2023 because, number one, the year over year comparisons will be easier. You're comparing prices now to the higher threshold they were already at last August of 2022. So sure, the number is going to come down, the raw number, but you're still going up. Okay. And when we do come down, you're not coming back down to 2% or 1% or 0, short of the Fed causing a massive global depression or China bringing it on, or however it comes about, if it does. But you're going to flutter down maybe to 4% range or 4.5% or something like that. That was a number that caused Nixon back in the 70s to impose wage and price controls because it was such a disaster. Not that they worked well, they didn't. So yeah, we're stuck with this, and I'll say it again when it comes to the financial markets. Nobody, for the most part, with very few exceptions, really understands still that this higher inflation is here to stay for all of these different reasons. It ain't going away. And I think that to some extent, maybe that was part of the hard message that Powell intended this morning, is to really stay on that hobby horse and make sure that everybody realizes that inflation is still public enemy number one. I just think that he's taking a lot of risk if, he's not going to put the onus on everybody else where it does belong and is appropriate, and think that he's got to single-handedly bring inflation down to 2%, because he will implode the economy if he does that.
Yeah, and if the market doesn't listen and reacts like it did today to hawkish sentiments, we're stuck with this for a whole lot longer.
That's right. That's right. So look, I think that the highs for the year for the stock market have been realized. I think that we ratchet downward now. I'm surprised that the market is not reacting more negatively today. It was up a lot, then it was down, then it's bounced back. But look, we are going to see, and I'll repeat it again, unless some shock comes to the markets in the form of a major bankruptcy in China, or some other shoe dropping with the banks in the US or something like that. 7.2 some odd percent mortgage rates are one thing. We'll see 8% before 2023 is over. We'll see 5% on a 10-year treasury before 2023 is over. And that will finally get the attention of the equity markets, which in that scenario, you're going to see the NASDAQ give back 20%. You'll see the S&P give back 8 or 10%.
Yeah. So we leave Jackson Hole and we go halfway around the world to Johannesburg, where there's another group of people that seem to be working completely against what Powell wants. And let's talk about the Brics nations and their meeting in South Africa.
Well, as usual, there was a lot of hype and misinformation ahead of the BRICS summit from the usual suspects. We had all of these predictions, not that they didn't come from some suggestions from some of the BRICS nations themselves, but a lot of exaggerations about we're going to have a new reserve currency that the BRICS are going to come out with backed by gold. And the gold bugs especially were flogging this whole meeting. I mean, to them, if Aunt Mabel's cat gets stuck up in a tree, it's bullish for gold. So you got to take all of that stuff with a grain of salt. But it was an important meeting from this standpoint, Mike, and I'm going to tie this into the basically impossible job that Jerome Powell has to single-handedly get inflation down to 2%. Again, unless he implodes the economy, then it'll come down to that level or less temporarily till they blow it all back up, inflate it all back up again. But the key takeaway of what the whole BRICS summit was about was one part of a speech that was given by Cyril Ramaphosa. He's the South African president this week. And I'm going to paraphrase it. I don't have it in front of me word for word, but you can look it up and see it or listen to it for yourself. He basically said, and this is the headline in my new issue, The National Investor, the gravy train for the colonialists is over. It's gone. It's done. Okay, no longer are you going to come into our countries and take our resources, give us crumbs, take those resources back and refine them in your countries to the profit of your countries and companies and use them for your benefit. Those resources are ours. If we're going to allow you to come into our countries in Africa and the other developing nations of BRICS, present and future, you're going to pay for them. You're going to develop them and refine them here. As a first matter, we're going to use them to give our people better living standards. This whole business of, we're going to have 30% of our populations live without electricity while you take uranium and copper and cobalt and have good power grids and stuff in your countries, forget it. So, the one storyline coming out of this meeting ahead of time, especially by some of the more hysterical and I think off-point stuff, is, well, we're going to have a new reserve currency that's going to dethrone the dollar. That's nonsense. We're probably, you and I, not going to live to see such a thing. But as bad or worse for the people in the West generally, for the people in the U.S. specifically, is that what is happening is going to raise our living costs substantially in the years to come. Because now, and especially here in the US, when the present administration will not allow very much to be developed here, and we think we're still going to rape these foreign countries and pay subpar prices to developing countries for resources, we were just told that that's done. And that's the big development out of this BRICS meeting, Mike, is that we're going to pay up for these commodities. And we're going to be reminded as the months and years go by how horribly we have been served by governments that didn't see this come. Well, they saw it coming, but wouldn't do anything about it, or thought that they could still browbeat other countries out of cheap commodities. It's over with. So when you're now going to have a BRICS bank at the least that is going to make loans for development projects so that local companies and entities in Mali, in Niger, in Brazil, in Argentina, in Chile, and elsewhere, now they're going to be looking at Chile first, at Niger first, at Mali first, and we're going to be the ones that are going to get the leftovers when this is all said and done. And we're going to pay premium prices for those leftover commodities. That's where this is going. And you don't need to have a reserve currency of the BRICS nations to enable this, because there's a lot of reasons why that's not workable anytime soon. But all you need to have is these countries working together and using currencies and day-to-day trade and making loans outside of the dollar. And that's what you're going to end up with. So forget about all this reserve currency crapola that people are pushing out there, folks. Commodity pricing is what the big outcome is going to be of this.
Yeah, no, I'm not disagreeing with you, and I saw this as a continuation of the de-dollarization conversation. They're setting themselves up so that they can look after their own without the use of the U.S. dollar as the main trading component. And I think the U.S. has done this to themselves with pulling, the sanctions on Russia, arguably. We can argue forever on whether that was a good thing or a bad thing, but by cutting them off the SWIFT the way they did, it raised alarm bells all over the world for other countries going, well, if we don't do what the US wants, are we going to get cut off from SWIFT? And these countries are basically looking after their own self-interest, and as they should.
Of course they should, and I don't blame them. I don't, as you said, we in the U.S. did this to ourselves. President Biden, with all of these sanctions against Russia and so forth, he single-handedly, and look, we had, even under Trump, and with issues regarding trade and some other things, we were already seeing the beginning of the reversal of globalization take place. And what Biden did with this proxy war against Russia, with weaponizing the dollar and SWIFT, with all of these sanctions and threats of sanctions, he accelerated this in a hyper speed, this move away from the dollar dictating all global commerce, or the lion's share of global commerce. And I'm certainly not going to say a negative word about these Brics nations doing what they're doing, because if I was a citizen of those nations, I'd want my government to look out for me too. I would want somebody in Chile saying Chile first. I would want somebody in Mali saying Mali first. Okay, because they haven't been. The dirty secret that has been laid bare by all of this, by President Biden shutting down projects in the U.S., but making a deal with the Democratic Republic of Congo to have child labor made or produced battery metals. What has been revealed with France and their colonial goings on to this day in nations like Niger and Mali and whatnot. I mean, this is all revealed. These people that are supposed to be the poster children of liberty, equality, and fraternity in the world, and brotherhood and all that, they're still colonial powers. They're still racist. They're still abusing the dark peoples of the world, if you will, to use the old colonial term, for their benefit, and so that we don't have to pay more for things in our country. And so these people are just rank, galling hypocrites who aren't going to get their way anymore. And what's going to make matters worse, as I've alluded to, Mike, is that in the U.S. specifically, when this same president, has got major development stage battery metals projects in Minnesota that he won't allow to be developed. You've got major copper projects in the desert Southwest in renewed question. Okay, fine. You want to pay $6 a pound for future imports from these other countries? Fine. Instead of maybe $4 to $5 a pound if we produce it in the U.S. You explain that to the American people why that's a good thing.
Yeah, I think I have 2 points to add to this. One is, I think we need to see a movement back towards more diplomacy and economic diplomacy, where it's a win-win for everybody concerned, as opposed to give us this or we're going to cut you off, kind of, which has been the diplomacy of probably going back to the Clinton eras. And further, if if truth were to be told, the other thing that concerns me about it is, for some of these poorer nations, are they just trading colonists? Instead of the United States and France in Niger and Mali, are they swapping us out for new colonialists in China?
Well, that's an extremely good point, because that has happened. There is also pushback against China, even though China is one of the anchors of the BRICS. And I think, and then we can go into a lot of different examples of how this has happened in countries like Ecuador, which, Rafael Correa, I always was a big fan of the former president in that country. But what did he do when he, for a while at least, got Ecuador out from under the IMF? Is he put them under China to some extent, and they got a $2+ billion lemon of a hydroelectric project for which they owe China. Now China's renegotiated that debt. But you're right, China is kind of the new colonizing power with the message like, hey, we feel your pain, we're one of you because the Americans did it to us before we did it to you, and so we're going to treat you nicer. Well, we'll see. There's that issue alone may cause some friction between the two anchors of BRICS, the other, of course, being Russia, because Russia, I think, in a more above board way than China, is trying to be a good, helpful big brother and not just a new colonizer, like China's been. So that bears watching. That's a great point. They're going to have to treat these other BRICS members, the ones now and the ones in the future, more fairly than the U.S. and France and Britain and the rest did.
Yeah, well, as I say, I kind of look at it the way I choose my cell phone company. My cell phone company sucks, but it sucks less than the other ones.
Right. Good analogy.
So, well, we've had lots to cover. It's been a week, and I think the fallout from this we're going to be seeing over the next several years rather than the next several weeks. So, something for us to continue to be watching. If people want to follow your musings as we go through these changes, how would they do so, Chris?
The two best ways are go to nationalinvestor.com. Make sure you're on my mailing list. There's a link there to sign up for my free commentaries and musings and whatnot that come out from time to time. And I'm all over social media, but the one I use the most is Twitter/X. And I'm there under @NatInvestor.
Wonderful. I look forward to chatting with you again in a few weeks as more economic news becomes apparent.
Yeah, well, we'll have, I don't remember the exact dates, but I think it's about mid-month, we're after another round of jobs numbers and the PCE number next week, the more full inflation numbers for August. We're going to have a Fed meeting to talk about in another 3 weeks, whenever it is.
Yeah, no, that's coming up again. And as I say, my bet's on another quarter point raise. Where do you land?
The one ahead right now, I think, is a coin toss. If we see across the board, even if it's just slight, a bump up in those inflation numbers, and there hasn't been anything negative as far as any kind of financial market event or something, I think that the odds right now are tilting in favor of them moving again in September. But we'll see. It's a coin toss. If they don't do it, then they'll do it some other time before 2023 is over for sure.
Yeah, no, that's one thing we do agree on. It's not over until it's over, as Yogi Berra used to say.
Exactly.
Okay, take care, Chris.
You too.
The Prospector News Podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.